How are we doing? How is everybody this fine Friday? How is everyone? All good? Forex Fire, Bill, Danny, Jules, Evil, Vitali, Linus, how are you doing? Right, back. Sorry I'm late again. We're going to be late basically every day. Let's face it. I can't do a stream for an hour. It just doesn't happen. It's one of those things, trading. You can never stop talking about it. My wife says I could literally talk all day. But, you know. So I have to have my little timer on, otherwise I will just talk all day. I've done streams in the past which have been 4 hours long. So we have to control it, people. Morning, Baggy. Morning, Phil. How are we doing? So today, basically, I'm just going to do kind of a Q&A type thing. If anybody's got any questions on anything at all. And also would obviously more towards strategy development if possible, but, you know, whatever. And obviously we're going to look at Phil's strategy in a little bit more detail and kind of analyze the pitfalls and come up with hopefully some ideas to try and do drawdown control on it. So the problem I have with the strategy at the moment is it's kind of a position trading strategy, and the Swiss Army knife EA is for testing mainly stop based and time based exit strategies, not for testing position trading strategies. So without building an EA completely for it, it's a bit difficult to test it with any real, because there's a million things you can apply to it, basically, the strategy. So what I'm going to look at today is just show you what the pitfalls are and show you what I've done with it so far. And then obviously we can look at ways to hopefully improve it. Hello, Noob. How are we doing? So if you've got any questions on anything, fire away. If you're watching on replay, comment section or Discord. And obviously I can answer questions on Monday, but or I can answer them in Discord. But I just wanted to use today for just general sort of Q&A and anything you want to discuss, really, or anything you would like a session on as well, because I've still got loads of content that I can do lots of sessions on. But again, I want to be kind of led by what people want. So if there's specific sessions you want, and don't say finding the Holy Grail or building a strategy that works, that's an ongoing lifetime project. But on anything else, basically, be good to know what you want to see, because obviously I can then schedule and you know, properly plan a decent session on it. So going back to Phil's strategy. So I've built the Swiss Army knife EA to have, and Phil's called it the lazy trader strategy, to have that as an option. So what it does out the box is, I just wanted to check that I'm not doing anything crazy in here. Yeah. So what it does basically out the box, for those that don't know, if you weren't here when we looked at it yesterday, is basically it takes a trade at 9 o'clock every night. It then targets, depending on whether it's a bull or a bear candle, it targets a 38% retracement. And then if it gets into more than one trade, because that 38 retracement doesn't happen, it takes additional trades. Yeah, and what I've programmed it to do personally, rather than looking for a specific pullback level, I've said just try and get me out with $10. Yeah, so if we get into a trade and it works, great. If we get into a trade and it doesn't work, we add another one and we just get out. Yeah, it hasn't worked, so let's get out. Try again tomorrow. We've got other trades going on because it's going to be run on multiple currencies, obviously, or multiple instruments. The other thing we've got available to us is obviously the lot size. It takes a fixed lot size at the moment. And we've got the opportunity to use lot multiplication. So in Phil's particular strategy that he sent me, he was using a 1.1 multiplier. So he would take a 0.1 lot. Then the next trade would be a 0.11. The next trade would be a 0.12. So he's using very just gradual incremental increases. That can be replicated by using a 1.2 lot multiplier. So in this, or a 1.1 stroke 1.2. So at the moment, what it will do is it will go in with a 0.1 and then it will gradually increase it. And again, these are things that can be tested. What if we went in with martingale? What if we went in with a 1.5 multiplier, but limited the maximum number of trades? So this is the sort of stuff I want to test today, and look at if there's ways that we can improve the strategy. But let me just run this one quickly on control points. This is a 4-year test. So what I want to do is just show you what it's doing and where the problems with it are at the moment. Just shut some of these out. Don't need that open. Don't need that open. So at the moment, what it's doing is obviously there we go. So if it's a bull candle, it takes a short. If it's a bear candle, it takes a long. Yeah. So we had a bull candle, so it takes a short. It targets a 38 retracement. That didn't happen. So the next day, it takes another one and gets out. Job done. So it's set up at the moment to use ADR spacing. And the ADR spacing that I'm actually using is half an ADR. And again, this is a variable. So we can test when we're doing system parameter permutation testing. We can test how far between each entry is best to use. Yeah. Bear in mind, this is a daily strategy, which is why we're looking at it, because we're looking at daily strategies at the moment. So we're taking one trade a day. So it would make sense maybe to use an ADR. So if we get into a trade short and it moves a whole ADR against us, let's have another crack at it. Otherwise, we just see if it chops around and comes back and hits that retracement level. So that's something we can test. So at the moment, he's using half an ADR. The other option we've got that we can test, let me check that box. The other option that we can test is the fib level. So we've got a 38.2% retracement. We could try 50. We could try 61.8. We could try a 23 retracement, which is kind of a flag break. Yeah. So it may be that we're better off trading and targeting flags. And this is an intraday strategy, scalping. Yeah. So we can try different levels there. So that's another permutation that can be tested. Obviously, martingale or lot multiplication is something that can also be tested. Yep. So those are the three main criteria that we can test. End of day or the time it enters, probably not something worth testing. But the distance and the lot multiplication are the main things that are going to affect this strategy's drawdown. The other thing we can test is the maximum number of trades. So I have it set here at 10. So what it will do is at the moment, it will only take 10 trades. So if, for example, we go short and it goes parabolic for 3 weeks, we're going to get into trades. We're not going to get out. It stops at 10. It won't go any higher than 10. Yeah. And it will then just literally sit there and cross its fingers. Yeah. So not great. So what I built into it this morning quickly, haven't tested it yet, hope it works, is close oldest trade if the maximum trade is hit. So this is very much like the drawdown control system built into Position Trader EA, where it will take, after a certain number of trades are entered into a position, it will start auto closing out the oldest trades. So if you set it to 10, as we have it at the moment, when we get 10 trades on, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, when it gets there, it will shut that one. Yeah, or 11. It will shut that one. Yeah, so when it takes the 11th trade, it goes, this ain't working. If it pushes further, it goes, we need out. If it pushes further, again, close. Yeah. So it's a way of doing automated drawdown control in the very worst case scenario. Yeah. So that is also something that can be tested with a system parameter permutation test, and using the number of trades. So I've set it up for 10 at the moment. So I'll just run it as is to show you what it does and where the pitfalls lie. So let me just scroll out max zoom. So the vast majority of the time, the EA's got a very good strike rate. You can see maximum drawdown here. Yeah, so it will automatically store what the maximum drawdown you see is. So as we're going through testing, it will watch the drawdown and it will log the maximum. So important when you get to the end of a test, because when you're doing position trading, the result that you get in drawdown is closed trades. It doesn't pay any attention or log the open drawdown. So I log the open drawdown. So I want to know, yes, fine, we had a losing trade of $5,000. That's logged in your results. But that trade, that trade, that trade, and that trade were all in drawdown at the same time. So it would have been way more than that. And this is why I say X3, anything you see down there, when you're doing any backtesting with position trading strategies, because you've got to allow for open drawdown. So I've got that logged. So we'll keep an eye on that figure, which is very important. But the strike rate is pretty high, as you can see. So we've taken 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, right, 10. So we had 10 trades there. And in all of those 10 trades, the maximum number of positions taken was 2. So it either was in, out, done, or it was in, didn't quite work out, next day, out. Yeah, 10 trades. Yeah, maximum of 2. Lovely. Market's still moving up and down quite a lot. These are daily lines you can see here. So in 1, 2, 3, 4, 5, 6, 7, 8 days, we had quite a big rally. And then we had quite a big drop for 8 to 10 days. No problem. It survives that because it's an intraday scalping strategy using it's a daily strategy using intraday scalping. But as you can see, the problem occurs when you get a sustained rally. So we've now taken $1,092 worth of drawdown. We've only made 328, but this is not atypical of position trading methodology. Position trading is not about making more profit. It's about letting the market move. Yeah. And as a result of that, you take drawdown. So you get to a point where you're in like somewhere about 4 to 5 trades. And I've noticed that roughly 4 to 5 trades is going to give you about 1K of drawdown. The problem we have is when you get to those periods where you get way more than that. So the squeezes. And again, like every position trading style strategy, squeeze is the problem. Yeah. And you can't avoid squeezes. They're going to happen. You've got to deal with them. You've got to come up with some way of controlling that squeeze, controlling your drawdown within that squeeze, which means taking losses. You can't just go, I'll wait it out. You can if you use a small enough lot size. And we looked at some of those EAs, didn't we, in the marketplace where they have those equity curves that just look like that. Yeah, they are doing position trading and they are not using drawdown control, but they are using lot sizing down here. Yeah. Where with a 10 or 20 or 50K account, you know, if the market pushes for an entire year, you're not going to blow it. Yeah, it never does that, obviously. I mean, the longest push you'll ever see is maybe a quarter. You'd always be out of something within a quarter if you didn't do drawdown control, if you're using small enough lot sizing. Obviously, that hinders your profit. So there you go. So this is using half an ADR spacing. And as you can see, it's pretty atypical of position trading. 4, 5 positions, 99% of the time. That's what you're getting into. That's where it tends to go wrong sometimes, where you get a push and accumulation. So we took 1, 2, 3, 4, 5. What's that? Sorry. I've got partial profit turned on. Yeah, I've got partial profit turned on. Right, so again, something else that we can test is closing a percentage of the position out or some of the position out when we hit a monetary target to help us do drawdown control. And this is something else I was going to look at today, which is why I turned it on this morning. So what we can do is say, if we are in drawdown heavily and the market pushes in our direction, let's close out half of some of these trades, and then we can use those to do drawdown control with. So it's another form of drawdown control. The problem with this is it's got to be discretionary done. You can't test discretion. Yeah, so I wanted to include it as an option, which is why I've put this into the Swiss Army knife EA, so that I can test partial drawdown exits as well. Yeah, I mean, that isn't going to be something that's going to help the trade, because you've now reduced these lot sizes, which pushes your average further away. But as you can see, we banked 400 and still got out. However, if this had gone down, it would have thrown out the lot sizing as we push. But what it's doing, obviously, as you can see now, is it's spacing the trades nicely out. Yeah, so with the initial version that I built, we haven't got that horrible getting into lots and lots of trades. Now, also with the the Swiss Army knife EA, the scaling in system works if there is no trade within half an ADR. Okay. Now, as you can see here, we've got a trade, and then another trade taken there. The reason that trade was taken there after the market had actually pushed up is because price had moved more than half an ADR up, and it was still more than half an ADR away from that position. So where you get instances where the price moves massively before you take another position, the Swiss Army knife EA will plug those gaps and assume that this is going to be a low and then continue to make a higher high. So it gets you out faster. Yeah. Worst case scenario, if it then drops further, all you're doing is you're plugging the gap where you missed the position. Yeah. So again, it keeps your average a lot closer. So that's just to explain that logic and why it works in that way. Let me have to restart this because obviously it's doing partial profits. And you'll see that that trade there that we had will be taken off at a different place now, because obviously those partial profits will have mean that the average would have been closer. There. Yeah. So it got out somewhere around here, didn't it? Rather than here. I mean, it's not far off, is it? Really? But so yeah, so it seems to be pretty good. We've taken $1,700 a drawdown on it. We've made 4. Yeah. So yeah, it looks like a good strategy apart from there. So there we go. So that's the first problem. Yeah, this is a squeeze. Squeezes happen. You can't get away from them. It's a fact of life. If you're position trading, you're going to get squeezed. So you got 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 trades. Yeah. So maximum we can allow is 10. If we're using that automatically get out after 10 trades and close the oldest, what would have happened if it had pushed down to here is that would have got closed out at 100% loss. So what you'd see in your P&L is something like that. Yeah. Nothing you can do about that. Yeah. If we use that functionality. But as you can see, the vast majority of the time, because we're using low lot size, we giving the trade the opportunity to play out. And it's a standard, you know, we're looking for a retracement, aren't we, on the leg. So if you stick a fib on this now, there's your 38 retracement. Well, it's not, you've got to class it from here. You can't use that one. So there's your 38 retracement. Yeah. So we talked about level indicators in detail on Wednesday. This is why they work. Yeah. If there is a large proportion of orders being placed in one direction, a percentage of the orders placed will be speculative and those will be exited, causing a percentage of the orders to be removed from the market, meaning that it will pull back by that percentage. This is always going to be somewhere in this zone. Yeah. So this is what position trading is all about. We can't time when they're going to take the orders off, but they will. They always will. There's never a move in the market you can see that hasn't had a pullback of 38%. Always. So it's just taking heat. And what we've got to try and do is control the heat. So we took $4,200 worth of drawdown. This is a 50K account. So that's just under 10% of drawdown. We've made over 10% profit. So at the moment, fine. You're always with position trading. You will find this with any testing you do with position trading. You're always going to find that roughly whatever you make on it is roughly whatever you'll draw down. So you will always draw down by roughly what you make. Most of the time that is going to be higher than you draw down, but the drawdown is, and again, position trading is not about looking at producing more profit. It's about using your account to draw down into. That's what it's there for. This is the thing that people miss about trading. If you've got 100K as a trading account or you've got 10K as a trading account, that's your working capital. As a business, your job is to spend your working capital to make profit. People go, oh my God, he's taken 10% of drawdown on his account. Yeah, that's the job. That's the business. Yeah, is to use my capital to make money with. Pension funds will draw down by 40% of the fund to generate capital. That's the job. You have a pension fund. You can only make money with that fund if you use the capital of the fund to risk on market movement. That's trading. This is what the bit that people seem to miss. They look for the holy grail risk reward ratio indicator, but they miss the whole purpose of the thing is to use your capital. Yeah. Capital preservation is rule number 1. Yep. So you risk small. If you risk big, you're not going to preserve your capital. It's just the way it works. But for some reason, that seems to get lost along the way of looking for the Holy Grail. Anyway, so as you can see, in times of high volatility, there we go. Perfect example. So that's the first time we've got 10 trades beyond. Yeah. And we haven't got the pullback. So now you've got to wait longer. And as you can see, this would have gone into 20 or 30 trades. Look at the drawdown, 50K. But we got out. That's not acceptable, is it? So we've got to find a way of controlling that. Yeah. So the first instance, and that's, I was waiting for that to happen, and it took a while. So that took 2020 in April, January 2023. So that took nearly a year to get to the point where it went wrong. We always get what? 1 or 2 squeezes a year. There it is. Yep. So as this strategy works as a position trading strategy, that's the downfall to it. The other way, the first way that we can control that is by using a maximum number of trades at the open to open on the strategy, but automatically closing those trades out when we get to them. Yep, closing out the oldest trade. That didn't work, did it? Is that turned on? Is that not working, that functionality? Let me just test this with a smaller number. This is because I bodged this together this morning because I wanted to. I spent all day yesterday getting it into the shoehorning it into the Swiss Army knife EA so that I could test moving average. That doesn't work. And then I wanted to get this functionality in this morning. I've obviously miscoded it. Why are you not starting? What did I set that to? 3, 4. And I set it to 3. I just want to see if it's going to close out the trades at a loss when we get more than 3 trades on. So where was that first big? Yeah, it's not working, is it? Logic's not working. Sorry, it's not going to help today. But I will get that fixed, and that's the first thing that we need to test with system parameter permutation testing is what's the best thing to do. How quickly should we start exiting these trades? The other thing, which is something that I think is probably the best way to test this strategy, is to live forward test it and do drawdown control manually. So you're going to find with this type of strategy that there is an instance where it is just going to continuously print money. Yeah. Which is the same with all mean reversion strategies. If you've got a market condition of mean reversion, range, balance, you're going to constantly make money. You can't not make money. So if the market goes down and you buy it and it goes back up again and then it goes down and up and down and up and down and up and it consistently does that for weeks on end, you will make money every day. There's nothing else you can do about it. Yeah. If you wanted to hemorrhage your account, you can't. It's just a way to print money. When it goes into a trend, you're then going to struggle. Yeah, that's what mean reversion trading is all about. So what you can do is use these periods on, for example, the pound CAD we've got here to offset any longer term trendy movements you get on other instruments. So if we bank whatever we bank a day here, and that obviously is variable because what we're doing is we're getting out at 9 o'clock every day. We're getting out at the same time every day, or we're getting out on a 38 retracement. So your profit on this is going to be based on how far the market moved in that day, because if it moved that far, your 38 retracement is going to make you a $5. If it moved that far, your 38 retracement is going to make you a couple of $100, isn't it? Yeah, because we're using a fixed risk, a fixed lot size. So your TPs are variable. You're going to get big days and you're going to get small days. And obviously you're going to get break-even days. But that pot is going to continuously build up as the market goes on. So using that to do drawdown on pairs that are struggling is probably, I think, the best way to manage this. And I think that's what Phil has been doing. But it's very hard to automate this in testing. You can't do it. So it's got to be done in live testing. It's really the only way to do it. So I need to get that functionality fixed. That's really annoying. That doesn't work. I'm just wondering if I can. Just trying to think how it works as to why it's not working. Anyway, so that's the first part of testing. Obviously, limiting the number of trades is no good on its own, because if you say only take 3 trades and it takes 3 trades and then the market continues to do that, all you're doing is you're leaving this trade down here somewhere while the market flies away from you, just going into drawdown indefinitely forever. That can't be done. So the other thing obviously we can do is we can say, right, well, let's not limit the upside of the trades and let's see if we can survive forever. Yeah. So if you run this with an unlimited number of trades, when it gets to that squeeze, it will basically just get out of it. Yeah. But you will have taken a massive, massive heat on your account. Too big. Yeah. Don't forget, we're also using a lot multiplier here. So we're going to test in a minute lot multiplication and just see what the results are on that. So this is the squeeze. $31K a drawdown, 40K a drawdown. We're at 56K on the account. 47. I tested this on gold, by the way. It blew. Trendy instruments. Not going to be good. There you go. So it blew. 52K. Didn't work. So obviously you just can't hold on. We know this. You can't hold forever, yeah? This is why we do drawdown control. You've got to have some kind of drawdown control facility to manage the squeezes. Otherwise, you will be squeezed potentially forever, yeah? Things change. Market conditions change. Fundamentals change. So they've got to be, you've got to have a control mechanism in place. So I'm just going to run a quick test here. I'm going to leave that on 99. I'm going to run a test on lot multiplication. And we'll start with 1. We'll go up in let's go up in 0.1 increments. And we'll go up to martingale. Now, obviously, martingale, in that sort of movement, if it doesn't get you out, it gets you dead. Yeah, we know that. Martingale is ridiculous. So I just want to see what happens at the 2. But, I mean, obviously, we would be looking at a much lower incremental. And so that doesn't work. No point in having that on. We won't test that at the moment. Adding to trades. So distancing. So I've chosen half an ADR between positions. So I'm going to test a quarter of an ADR in quarter of an ADR increments up to I'm just going to go up to 1 ADR. We'll see how many tests that is. But I think 1 ADR is probably enough. The other test that we can do as well is so that we do not get these squeezes, right? The strategy's got a fairly high strike rate with 1 or 2 trades within a position. Yeah. So and again, same thing we went through in the strategy robustness testing part of the member streams. One of the things I do is I visually eyeball. I do this exactly what I'm doing here. I look at the strategy playing out, because your job in strategy development is not to make something more profitable. It's to eliminate the problems. So like I said, the first thing you've got to do with any strategy is identify the Achilles heel in the strategy. With all position trading strategies, the Achilles heel is the squeeze. If you have a strategy with a high strike rate of 1 to 2 positions, in this case, which we have, and the strategy takes a trade at 9 o'clock every day, one of the exit criteria that we can test is if the trade hasn't played out within 24 hours, get out. Yeah, because it hasn't worked. Vast majority of the time, probably more than 50%, it works with either 1 entry or 2 entry, meaning that the trade is completed within 48 hours. So we can use a timed exit to exit the trades after 48 hours. So what it will do is it will automatically do drawdown control every 48 hours on a trade that's open, meaning that we will only ever have a maximum of 2 trades open. So we'll take trade number 1. Yeah. Give it time to play out until 9 o'clock the next day. If we need a second one at 9 o'clock the next day, give that trade time to exit. If it hasn't and it's pushed down, we take another trade, but that one will close out because 48 hours has passed, meaning that we now can get out here, not here. So we're going to take constant losses. So the P&L will go like that, and then it will have this sort of thing when we get into a squeeze, rather than this, rather than what we just saw. Yeah. So it controls drawdown as we go. The amount of drawdown will be determined by the speed of market movement. Again, not in our control. So that's something else that I'm going to test, but I'm going to run a test on that separately after I've done this one, because I want to see, first of all, what the parameter permutation does on this. This is going to be over 4 years. Let me just see how long this is going to take. Might reduce the time, but I want to include that squeeze. This is only testing one, obviously, instrument as well. So if you're going to, we would run this 44 tests, 10 minutes. So let me just start that again. That's right. Let me just quickly run a test. I've got to speed this test up, that's all. I was going to run it. I don't know if this will work on open prices. Should get the same results. Let me just run this test quickly without optimization on control points and on open prices, just to see what the result comparison is, because on open prices we can get this test run in less than 10 seconds, but I need the variance to be tiny between the two. $1,800 drawdown, 6.7 profit. 1,800 and 6.7. 6.4, 1,700. Perfect. So the variance is tiny. So we got a $35 variance and a $300 variance on profit. 348 trades. Let me just make sure it took the right number of trades as well. So again, this is, again, we covered this in the backtesting streams, but obviously if you can test on open prices, and this EA works on open price, don't forget we're taking the same trade at the same day at 9 p.m. So we're only waiting for the candle to close at 9 p.m. and then we're going like that. So we can use the open prices of candles. Yeah. So we can use open price testing. So that makes our robustness testing infinitely quicker. So let me just run this test on, I have to run it on control points. Start again. So we're going to run 44 variations here. So robustness testing of 44 system parameter permutations. There you go. This test is going to take 20 seconds. Was going to take 10 minutes. Massive difference. So I want to see what works and what doesn't. We're testing martingale and we're testing distance between trades. That's all. So whenever I'm doing robustness testing, I don't test everything, because you're looking initially, right, is it better to multiply our lots or not? Is it better to space close or far apart? Those are the questions I want answered. So I'm trying to control the drawdown and the squeeze of the strategy, and I'm looking at whether it's better to increase lot size because it can get out fast, which stops the squeeze happening, or if we can't stop the squeeze happening, is it best to be further apart or closer together to get out quicker? So we're either going to try and get out quicker so we don't experience the squeeze, or we're going to have to take the squeeze, so we're going to need to spread ourselves out so that we survive the squeeze. Those are the two things we can do, because we can't control the squeeze. The squeeze is happening. Yeah, your job is to live through it. That's all you can do. We can't control market. So that one generated 22k of profit. Let's just sort it by profit factor, and took 14k of drawdown. Martingale. Yeah, so Martingale, obviously, as we know, is going to generate a hell of a lot more money, and it's going to generate higher drawdown. Yeah, it's the highest drawdown, and it's the highest profit. No shock there. It's also the highest risk of blowing the account. That is spacing at half an ADR. So let's look. We actually only blew the account on 2 occasions. Again, using Martingale 1.9 and 2. So, and using a quarter of an ADR spacing. So this is kind of confirming what I would expect. When you get into a squeeze, if you put your trades too close together and you increase your lot size too fast, i.e. using a 1.9 or a 2 multiplier at a quarter of an ADR distance, it's going to hurt. So that made a massive loss. But those are the only 2 instances. So let me test this again. This is a 2-year test. Let me test this over 2020. So we're doing a 4-year test, much longer test. This will take about 20 seconds, 30 seconds to run. 1 minute, 26. So we'll test it over that longer period, meaning that we're definitely going to get that huge squeeze in there. So let's see what survived and what didn't. A lot of big drawdown going on here. 128% drawdown. This is the beauty, this setting that I said about the other day, skip useless results. If you turn that off when you're doing robustness testing, it gives you all the actual outcomes. So it basically, what it does is it says, you said you're using a 50k account, but I'm going to ignore that and let's assume that it's bottomless. So you would have drawn down 128% of the account, i.e. you would have blown it twice over. Not good. So there we go. So running that test over 4 years, nearly done, gives us results that are profitable are roughly half the results. Yeah. The ones that work, spacing is between 0.75 and 1 on the vast majority of those results. There's a lot of 0.25% that work with Martingale as well. So, but overall here, what it's saying in these results is you're better off using a high lot multiplier of 1.6, 1.8 and Martingale on 1.5 on all of the top positions, and spacing your entries somewhere between half to an ADR over the majority of them. There's a couple of quarters in there as well. So it's actually pretty inconclusive. But look at the drawdown. Yeah. So we got one there at 67, but the vast majority of them are looking at somewhere in the region of 14%. Now, don't forget, this is closed drawdown. So if we run this one here, which gave us a 7% drawdown, let's run that. This gave us a 7% drawdown. Let's look at what the actual open drawdown on it was. So 4.6. Oh, that's spot on. Maximum drawdown. Okay, so the maximum drawdown is actually the, that's interesting. So the maximum drawdown is actually the reported figure. Let me just try this one as well. So we should get 14.2 on this if we run this test. Six, 8. Why is that only given 6.8 drawdown and made 70 grand? Martingale 2, ADR 0.5. 2. .5, yeah. That's interesting. So basically this the correlation between this maximum drawdown and the actual closed drawdown, the reason being, I think, is obviously because we're using Martingale here, when we're getting out at a break even, because that's basically what it's asked to do, is make $10, isn't it? Just to get out of the trade because it's wrong. Some of these positions are very, very big. So the furthest away positions when we close out are actually massive. However, the maximum we go into, because these didn't go into drawdown themselves, I guess. Oh no, those ones didn't go into drawdown. I don't know how that works actually. That calculation doesn't really make sense, does it? That is the maximum open drawdown though, because it's calculated from the highest figure that is achieved there. That doesn't seem to be reading right, does it? Doesn't make sense. Anyway, but what I'm looking for here, anyway, it doesn't really matter, is I'm looking for something that survives and basically has a fairly low drawdown. So the lower numbers are obviously going to be better than the higher numbers. That's really all we can take from this. The actual numbers, you're going to have to run individual tests. This is the problem with position trading. If this was a stop-based strategy, you're always going to get exactly what you get, because it takes the closed trades and puts them into the P&L. With position trading, there's this floating P&L that is unknown, always unknown when it's running the tests. And how this actually calculates the maximum here is a little bit difficult to calculate when you've got so many positions on. So I think that's kind of got to be taken into taken with a bit of a pinch of salt in this particular case. But so conclusion of that is spacing. We definitely want to use half an ADR or an ADR, and martingale at high levels, or rather lot multiplication at higher levels, is going to be better. It's going to get you out faster. So in this case, we took a 20 grand profit from a 6-8 drawdown. Not bad, but still it's a lot. So what I want to test next is end of day exits. So timed exits. So exit after amount of time. So we're going to exit after 2 days. Actually, I might just go 48 hours. Yeah. So I'm just going to say basically after 2 days, if the trade hasn't worked out, get me out. And I want to start at 48, and I'm going to go in 24-hour increments up to 96. So I'm going to give it 4 days basically to run. I'm going to keep it half an ADR because that seems to be pretty consistent in the results. Lot multiplier. I'll tell you what, we'll run the test again with lot multiplication. So we're testing lot multiplication and whether we should get out after a period of time and see what impact that has. So let's just run that as an optimization as well. So this is what I'm trying to do, is get this thing as automated as possible so that we can take as much discretion out of it as we can. Because obviously the best way to do this is always going to be to use discretion. However, you can't test discretion. So I'm trying to find the best way to implement the strategy to start with, and then obviously when you apply discretion to that, hopefully you can improve the results of the strategy. That test is taking a long time. Obviously testing end of day exits takes a lot more computing power. There we go. Tiny drawdowns. And much more stable results. Much more stable results. Exiting after 3 days using martingale produces 16 grand of profit. Very nice. But it also produces 17 grand of drawdown. Do you see what I mean about the drawdown roughly equaling the profit most of the time? It's just that's a byproduct of position trading methodology. That's just what happens. Okay, so martingale at high levels, so lot multiplication at high levels seems to be better, which again is logical, because obviously what we're doing is we're taking losses as we go, meaning that the further we get pushed, the higher the probability of the pullback. So what we're doing is, as we're closing these positions out as we go down, our average price is really sticking close to where we are at the moment. So we literally need a tiny little pullback every day to get out. Yeah, these are pretty good. So let's just run this, one of these. They're all pretty average. Look at the profit on it is pretty stable with the drawdown. They're all, I don't think it really matters which of these you pick, to be honest. I'm just going to try that one because it's a 1.5 lot multiplier. Martingale I would never use. Just not going to work long term. So we made 2.5 grand. We're on $600 a drawdown. So first of all, I just want to check this is actually doing what it should be doing. So we've got a long on there, push down. So we should close that position out here. Perfect. So it's taken a loss basically on the trade if it hasn't worked out within 3 days. Good. So that's basically kind of turned it into a timed exit strategy using a stop criteria. So if for 3 days you got in and that trade isn't working, stop yourself getting into a squeeze on it. Yeah. The chances of you getting out of that within 3 days is high because we've observed visually that the vast majority of trades are 1 or 2 positions. So by the time you take your third one, if it hasn't worked out, the likelihood it isn't. So let's cut it. Let's get out. So equity curve on it. You're going to get dips. You're going to get stagnation because every stop loss based strategy goes through stagnation. Yeah. But when the market is not in a trend type market condition, which it isn't for the vast majority of the time, it's going to work out very, very well. So that's not a bad entry exit criteria. So Phil, timed exits are one good criteria. However, applying timed exits and drawdown control is also going to make the strategy more profitable. Potentially. So using some of this that you're building up on some currencies as you go along, and then using that to reduce the drawdown on the ones that are going against you. So maybe using 20 to 30% of your profit to reduce these, you'll probably find that some of those you'll actually be able to get out of without taking a loss on them, meaning that the overall profitability of the strategy will be higher. That's something quite complex to programming in his discretionary. So that would work as well. So it's not a bad strategy. I've got some work to do on the EA to make that work as I really want to test it properly. So I will do a little bit more work on it so that I can do a more robustness testing. But timed exits, remember when we were doing the session on exit criteria, timed exits are much better than stop losses in the vast majority of cases because you're giving your trades time to work out. However, if they haven't worked out in the time frame that you observe is the norm or the average, get out, cut it, be gone. Yeah. So just remove those. That stops your squeezes. So you've got 2 options with the strategy: squeeze or no squeeze. But manual drawdown control. So this is really very similar to the position trading EA, the position trading strategy that I use with RSI and ADR. The difference is this gets in every day regardless, doesn't it? Yeah. So it's kind of taking my strategies to a more scattergun or shotgun approach. But as we know, market movement works, and as we know, pullbacks work and market structure exists, the strategy takes advantage of the fact that that happens most of the time. So it's a good strategy in that you're going to be always in. It's a bad strategy in that if you ever get into the multiple currencies at the same time that are correlated and you get a squeeze happening, you're going to take multiple losses at the same time after 24 hours or multiple squeezes. So the key to this strategy specifically is going to be exposure. So you're going to need to find a maximum, I would say, probably of 6 instruments to trade it on, and make sure there's no correlation or very, very low correlation. So the easiest way to do that is to load this up into the strategy tester, run it on I don't know, 10 or 15 currencies. Let me just open strategy quant. So the easiest way to test correlation, historical correlation, is in here. So if you go into strategy quant and just load up some strategies that you've, or rather some back tests. So I'm going to load all these back tests up. These are just other tests I've done on ADR. Yeah. So we'll create a portfolio of those strategies. We'll go in there. We'll make sure that we've got them set right, the right amount, which we haven't. And then go into portfolio correlation. Yeah. So anything you see that is not really bright lime, yeah, don't trade those. Yeah. So what needs to be done with this really is an automated test with kind of how it would initially be deployed, and find out where the correlation lies, and then make sure that we're using the non-correlated pairs. And again, this is historical. Whether these pairs become correlated in the future is going to be dependent on interest rate differentials. That's changing on a regular basis. But, you know, you can't plan for everything. This is why you have to be a trader, and you can't be a robot, because this thing doesn't do the same thing every day, week, month, year. Yeah, markets change all the time. Yeah. So, but we can look at where we definitely shouldn't be correlating. So you should not be trading euro US dollar against the New Zealand dollar US dollar. Yeah. They are 81% correlated with this particular strategy that I've just run. So don't trade those. Half the time, if you trade the pound US dollar against the US dollar, they're going to be correlated as well. So this tells me that I should be trading the euro US dollar, and I should exclude New Zealand dollar and pound US dollar. Yeah. Because that one is not correlated with everything else in any way, shape or form. So let's remove those two. Yeah. So run the test again without those two in it, and then make sure there's no other correlation. I know there isn't because it's here. I've got them all here. But so yeah, so that needs to be done on it as well. So I will work on that, and try and get that, because there's a couple of other tests I want to run for exit strategy. The downside to this is it's position trading, which means you've got to have discretion. You've got to do drawdown control, and there is no obvious mechanical way to do drawdown control. One other thing that I might implement in it is negative, kind of a negative balance protection, if you like. So if we go into drawdown by X%, start closing out. But what you tend to find that does to strategies is it produces these horrible continuous loss equity curves. You're better off, as I just shown there, it ain't work, shut it, because it's got such a high strike rate. Yeah, that's the beauty of this strategy, and why I like it, why it caught my attention, is the strike rate. Look at it. It's like it's in, it's out, 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 because that's all the market does. Goes up, goes down, goes up, goes down, goes up, goes down. You can't get it wrong. If it's moved up, target 38% of the retracement on a fib. Yeah. This is what everyone else is trying to do. They're trying to get in on the 38% and it goes to 50, so they miss the trade. Or they're getting on 38 with a stop under the 50 and it goes to 61.8. Doesn't matter which one it goes to. Mean reversion, doesn't matter where it goes. We're looking for it to go somewhere. We don't care where. It can go down there. I don't care. I need you to move. That's all I want. I want the market to move, because if it moves, you can extract money. Beautiful. So yeah, good. I like. This strategy is very akin to virtually all of the daily trading strategies that I was going to run through, because they all use either bar exit or time exit. Yeah. And with daily strategies, which is kind of what this back end of this week's sessions are meant to be about, is all daily strategies work well with timed exits. So because we're entering at a point of day, and usually at the end of the day or at the start of the day, what we are saying is, if the market does what we want, get out. If the market doesn't do what we want, get in. But draw a line somewhere. Yeah. So all of the other strategies, the RSI2 strategy, the NR4, NR7 strategies, all Tony Krabel's work, all Larry Williams' work, all Larry Connor's work, all daily, all timed exit. Yeah. So what the concept of the daily strategy is we get out if we worked. Yeah, that's it. So the amount of money you make is not determined by a fixed risk reward ratio, a TP or stop loss. It's fixed by, did the market go in the direction? Yes, brilliant. Get me out. That's it. So we are using, in this particular strategy, a combination of the two. We have a TP. Did it go to where we wanted it to? No. Yes, eventually. Yeah. But you can also, you could also as well, and this is the other test. Let's quickly run this one as well, because this would be a good test to do. Let me just take that off. I'm going to leave that at 1.5 for the minute. And I'm going to leave it at half an ADR for the minute. I'm going to turn that off. Actually, no, I'm going to leave that on, but I'm also going to turn on end of day exit. We need to test that. That'd be a good test, actually. True. So what I'm going to say is exits at the end of day if we've got profit, regardless. And this is one of the main Larry Williams exit criteria, is the end of day. It's called the end of day close, basically. So you have two versions of it. When you get in, if it's in profit, at the end of the day, you close it. If it's in $1 profit or $1,000 of profit, you shut it, because your trade worked. Yeah. Our job is to get in and make money. We did. Done. If it's not in profit, then you have a backup plan. Yeah. So that was his strategy, was basically buy it because something's happened. And one of his strategies is the 3 down days. So you go down for 3 days and you buy it. If it goes up the next day, get out. If it doesn't, buy it again. If it goes up the next day, get out. Rinse and repeat until it does, because it will, and it always does. Yeah, that's his strategy. Very simple. Made millions doing it on the S&P 500. So yeah, we'll test that one as well. I will test that one. Okay, let me just run this one, because this is basically oh, that's what I was going to do. So on the strategy, instead of targeting a 38.2, I'm going to target a 68 retracement. So what I'm saying is, what I want is more money out of you. So in this particular case, my target would have been up here. But I'm also saying, if I don't hit that and it moves down, and at the end of the day, I've got a profit of something, just take that. So I either want loads of money or anything you can give me. Yeah. So I'm just going to try this as a little test. Woo. And see how many times we hit that. Nice. As an option. And how many times we don't. So we made 2.8, 3K, lost there because we closed out after 72 hours, didn't work out. We're up to 3.3, 3.7, 3.9, nearly touched 4K there. There we go, 4K, 4.8, 4.4, 4. We've still taken $1,200 a drawdown, but we're up at 3.5 grand. See, the equity curve is going to have a lot more dips in it because we're using basically an exit strategy, which is a loss. 4.6. Doesn't really smooth it out much, does it? Doesn't smooth it out much more. So that's inconclusive. Not really any advantage to doing that over what I just tested. So pick one or the other. Doesn't really matter. So what I was trying to find out there was, does the TP get hit more than the exit after 3 days makes you profit? Yeah, and it doesn't seem to make any difference. So what you could do with this strategy is basically just get in when the market's moved down, forget about the TP, just let the market run for 3 days and then get out. You get roughly the same profit. Random. Just random, isn't it? Yeah, I'll do some more testing on it. I need to just shoehorn some more bits in. 45 seconds left. That's not a bad session, is it? Pretty much to the time. Yusuf, morning. Can we try indices long only on M15 RSI2 595 with the position trader EA? Indices long only on M15, RSI 2, 595. But what's the criteria? You can't just say that because there's 100 inputs. um, what's the exit criteria? How do we get out? Is it a position trade? And if so, what targets and stuff? I can't, you can do this. You can do this test. You can use the position trader EA to do that. Oh, why haven't I got 1.63 in here? I need to put that in this account. I think the only difference is this is the development one, isn't it? So yeah, you can try that on the indices. 595 on the 15-minute RSI. How many times do you hit that? Uh, 15. This is the DAX. So it's quite a few instances, isn't there? So short there. So are you entering as you get down? What's the entry criteria? What are you using, an MA cross? I'm just marking these rough at the moment because obviously we'd need to check entry criteria and exit criteria, but didn't hit there. There. See, somewhere there you'd need to figure out how you got in, but down, bit up, bit down, bit down. Nice big up, nice big down, A-shaped recovery. Nice big up, little bit down. Let me just put period separators on. How many times does this happen a day? 2, 3, 1, 2, 3, 1, 2, 3, 4. Right, so my version of the DAX that I've got here with Robo Forex, this is from the open to end of day, so there's no pre-market data. So this is when you would trade it, but so this is actually quite good. 1, 2, 4, maybe 5. So yeah, you're getting somewhere between sort of 3 to 5 signals a day, aren't you? It would have to be a scalpy type strategy, I think, rather than position trading. Will this be released as a new EA if it turns out to be good? Yeah, I will. So yeah, obviously if Phil will get a free copy, but yeah, I would release it as an EA because I mean I've obviously have put a lot of time into building it, developing it, testing it, running it, updating it, supporting it, doing all that sort of stuff. So yeah, I'm happy to release it as an EA. Risk 0.5% on 1 ADR distance, long only. EMA 5 on M5, but you just said, oh, it's you're doing it on there, right? Okay, let's set it up. Let's have a look. So we are using RSI. Let me reset this. So RSI and using 0.5% over 1 ADR and lot multiplier, I'll leave it at 1.1. We're getting in half an ADR apart, 1 ADR distance between trades. Surely this is a scalping strategy, isn't it? This isn't going to work because if you're saying I'm going to get in there short, and then you're saying if that doesn't work out, let's leave it an entire ADR before we take another trade, regardless of what's happening intraday, it's a pointless strategy. You might as well flip a coin. Just the fact that it's got up to there and that's the button press. Your exit criteria here is just position trading on the daily time frame. To me, this is a scalp 10 pip type strategy, in out with a stop. I would do something along the lines of risking half an ADR, 0.5% over an ADR, and then using drawdown control. If it moves against me by 0, so let's just do 1%, it's easier. 1% over half an ADR. If it moves against me by, let's say, a 10% ADR stop, 0.1, and target a 0. I mean, this might actually have a high enough strike rate to use a 1-to-1 risk reward ratio. I mean, I don't think it'll work as a position trading strategy because you are literally just flipping a coin. You're saying basically on the 15-minute time frame, if the DAX gets extended below 5, buy it. Then what? Targeting half an ADR, 0.5% or 0.25% of money. You can't target money if you're risking over 1% of ADR. You'd have to target a percentage movement, not monetary. If you're risking money, so if you're risking money, $1,000, this is why you have these exit targets as a percentage and exit targets as money, because if you're risking percentage, you target percentage. If you're risking money, you target money. So exit targets as a percentage of balance wouldn't be used. It would be risking a percentage. So that's over 1 ADR. So we'd need to target 500. So half an ADR or 1/4 of an ADR a movement. It's probably the best thing to do because we're looking for a scalp, aren't we? But if it moved against me by, yeah, so you can't do drawdown control over money. It would all need to be done over percentage drawdown. It would need to, it's quite confusing, this one. I think you might have found a really nice intraday scalping strategy. If you can wait, let's look at the DAX. FTSE's gone nowhere today, look. Should have taken a 2R on that. Okay, DAX is on its way up to target. But let's look at the DAX up here. Let me stick an RSI on it. What RSI were you using as well? RSI 2. Oh, sorry, yeah, RSI 2, wasn't it? 595. Yes, so short it now. Or get ready to short it now. And you should have been getting ready to long it in here. This is an hourly time frame. Let's do it properly. It's 15 minutes. Isn't it? Yeah, so you had long signal in here today. That's pre-market. Hang on. Is it pre-market? Yeah. So that's the open, isn't it? So this is your first signal today here to go short. So get ready to short. I mean, it's logical, isn't it? We've been rallying for 15 minutes. It's going to pull back. Short signal, scalp. Short signal, scalp. Short signal. That would have stopped out. It depends how you manage your trailing stop. Long signal, stopped out. long signal. Nice. I think you might have had a scalping strategy. 2 RSI on the 15-minute time frame. Drop down to M5 and wait for a moving average cross on the M5 time frame. You'd need to play around with the position trader EA to try and execute this. But make sure whenever you're using the position trader EA, always make sure that you are, whatever you're using here, percentage risk, you are using the exit targets for percentage of balance. So you're risking your percentage of your balance over ADR, you target a percentage. If you're risking money over ADR, you target money. Yeah, this is why fixed lots is no good, because to target fixed lots you'd have to target ADR, and ADR is too much of a variable, which is why I don't do it. Which is, you know, somebody asked me the other day about this. Can you put ADR distance as a target criteria? No, because it's variable. You can't get reliable results testing with variables. Yeah, if something changes constantly, the percentage never changes. 25% is 25%. $200 is $200. One lot is totally different based on the average daily range of the instrument. So it's worth testing that. Making some tests with it looks not bad. Yeah, I'm pretty sure you'll be able to do that. Get that working. Just copying Larry Connors, but on the 15-minute time frame, not daily. Yeah. So the Larry Connors strategies, the RSI2 is Larry. For those who don't know, that is one of Larry Connors' strategies. Very successful RSI-based strategy for stock index trading. He made a fortune out of it on the S&P 500, and it works very well in a bull market. It does not work in a bear market. The last 4 years, you would have blown your account. Yeah. Be careful. We've never had what we've had. This is the thing. This is the thing with all trading. This is what I keep saying. Yeah. Larry Connors made an absolute fortune in a bull market. He never experienced a pandemic bear market. No one else had experienced one either. We're the first generation to have ever experienced a year-long bear market. Never happened. That strategy does not work in it. Admittedly, it's never happened in the last 25 years, just once. Probably won't happen again, or will it? How many pandemics are we now going to get since we've had one? Maybe we're going to get one every 3 years, in which case then RSI2 daily is never going to work. Can you see the future? No. Should we be trading it? Yeah. But I tried to apply many of his strategies down to lower time frames. They don't work because they are based on push-pull in stocks. So as the whole concept of it is, as stocks become cheaper, they become more desirable, which means that what you get is a bull market that continues with pullbacks. RSI2 measures those. Yeah. So RSI2, pullback, long. Pullback, long. Pullback, not really long, but going long. Yeah. So that's what it's doing. But obviously RSI2 extended and embedded hemorrhage. This is why we use a price action signal. Yeah. Condition, signal, MA cross, moving average cross, reversal alert, or price action. Yeah. So the condition is met, but you would not have got in anywhere here unless you'd have had a signal that said get in. The signal you received was here. Perfect. So it's good. It's a good strategy. It's an extreme, an absolute extreme. It's absolute exhaustion. It's the same as ADR. I trade a strategy, and I've traded this strategy for a long time, and I'm trading at the moment actually on in futures. I've got a futures account going at the moment. I said I wasn't going to trade futures, but I have. I'm just going to do this over here because I don't know if it gives all my logins away. You working? Oh, yeah. So this is the same sort of thing. Yeah, this uses stochastics, not RSI, because stochastics is faster. But this is a strategy I used to trade a long time ago, and I've resurrected it, and it's an absolutely brilliant strategy. In fact, I think we've got set up short right now. So these are stochastics, four different stochastics. Basically, each of these stochastics is a different time frame, a different period of time. So we're looking for absolute extremes. 91, absolute extreme. The 5-minute stochastic right now is right up there. This is a 1-minute chart. It's right up there. Yeah, you can see it's right up there because price is right up there. Yeah, the stochastics was right up there. You can see it's right up there because price was up there. Like I said, with all this week, we've been looking at condition indicators and stuff. Yeah, price tells you what it's done. The condition indicator just goes ping. Yeah, you can see what it's doing. But yeah, right up there. But we've got beautiful bear divergence at the moment. Yeah. So at the moment, stochastics is showing a lower reading, means we've got less volume coming in at the moment, means the market is weakening, but we're making higher highs, which means that it's exhausting. Yeah, RSI2 is doing the same thing. When you get up to a 95 level, it's really, really been pushing. There's not going to be anybody left. It's the same principles that we trade with all mean reversion strategies. There's no one left. Yeah, look at this candle. Yeah. We've got limit orders, we've got exhaustion, and we've got a signal that says, looks like we're running out of people to sell up here. Sure. Yeah. We've also got bearish divergence, meaning that this move is definitely petering out. However, when you press the sell button, it is either going to do that or it's going to do that, because the next 1-minute candle is either going to have a bigger or a smaller differential of buy and sell orders. That is the future. But this is a repeatable pattern. So what you've got there is very much the same thing, isn't it? Yeah, absolute exhaustion. Get ready to short. Looks good. Yeah, do some testing with the position trader EA and see what you get. But it's more of a scalping based strategy. I'm just trying to think of. Yeah, I mean, you want to be out, and what you want to be doing is, like, I missed it. Let's take it anyway. I'm going to take a short here, right? Because this is a setup, and I'm then going to place my stop loss here. Whoa, no, I'm not. That's I'm going to place my stop there. Yeah. What I'm going to do, and this is what you need to do in scalping, is as this trade works out, if this trade works out, you are constantly minimizing your risk. Yeah. What I'm looking for is, as soon as this gets down here, or that, but it will be that one, and I see signs of bull price action, I'm going to get out. But what I'm going to do literally is target 1R. Yeah. But what I'm going to do as I'm trading and as the trade plays out is I'm reducing this down. So if I can get a strike rate of 50-50 with a 1R, which is all you need to make money, but as your trade plays out, you minimize this risk. If this stop gets hit now, I've taken less loss than I would if I hit my target. I'm going to get a 50% strike rate with this particular type of strategy because it's very, very reliable. Any exhaustion, any mean reversion based strategy, yeah, is going to work over 50% of the time, because it's the whole purpose of it is the market can't continue to do it. That's the unknown. How far? It will either do that, or it will do that, or it do that, or it doesn't matter what it does. As long as it does that, we make cash. Yeah. So you just got to find those exhausted conditions, and that's what we covered this week. The condition indicator. I just need to cancel that order off. A condition indicator. Yeah, that's what a condition indicator is doing you. Is it's telling you there's a high probability of a reversal coming, but the risk reward is what makes the profitable trade or the loss trade, not the condition. But RSI2, with condition indicators, we covered it very quickly this week, but obviously adjusting your condition indicators and giving them either a higher or a lower sensitivity. The higher the sensitivity, the faster the measurement is, the faster you need to be in and out. So if you use RSI2 for a multi-day position trading strategy, you're using an indicator which is going to trigger all the time. So all it's doing is going flip a coin, flip a coin, flip a coin. Yeah. So if you're using RSI2, you need to be scalping. Larry Connor's, yeah, RSI2 strategy on the daily time frame was a scalping strategy. And this is, people have trouble getting their heads around this. You can't scalp on the daily time frame. Yes, you can. Scalping means getting in and out quick. So if I scalp here, because let's say I'm using the RSI 3070, right? If I take an entry here, yeah, the scalp is, if this trade pushes up tomorrow, I would close it. Yeah. Every time frame you can scalp on. You can scalp on a daily time frame, you can scalp on an hourly, you can scalp on a 5 minute, you can scalp on a 1 minute, you can scalp on a tick chart if you're trading futures. Doesn't matter. The definition of scalping is, I'm going to take a trade and I'm going to get out if it goes my way really fast with a small amount of money. It's not, I'm going to trade the 5 minute chart. Yeah. Entering on a daily time frame and getting out on the next candle is scalping. You're out one candle later. Swing trading is, I'm going to get in here and I'm going to hold it for many candles. You can swing trade on the 1 minute chart. You can swing trade on the daily chart, but everybody assumes swing trading is high time frame. Swing trading is moving in swings. Swings happen on 1 minute time frames. Look at this thing. Yeah. Swinging all over the place. Yeah, there's a swing low, there's a swing high, there's a swing low, there's a swing high. I'm swing trading on the 1 minute chart. However, I can also swing trade on the daily chart. But swing trading, you will hold for multiple periods of candle. Candles are a view of time. That's it. Yeah, we're viewing price over time is a candlestick. What time frame you trade has got nothing to do with this methodology of trading. Broke that high. So I would have stopped out on it, but I took less loss on that, $21, instead of 35-ish, probably would have been, if I'd have left the stop in place. Because I'm scalping, I want to reduce my risk quickly because I'm expecting this to play out fast. If it hasn't played out fast, it isn't going to play out. So it's a good scalping strategy, I think you may have discovered. But it's not it's not hidden, is it? We know about it. It's RSI2. But when you try and apply anything to a low time frame, you kind of need to use higher risk because you're not going to make much movement. You will occasionally catch a biggie. And this is where the in and out on the opposite signal works well. Yeah, the opposite signal gives you an exit because you need to get in the opposite way, don't you? And that's exactly what I do with this strategy. I get in. If that divergence had have worked, which it hadn't, which we've still got divergence in play. It's not very clean anymore. If this trade have worked here, yeah, and it hadn't have hit my target and this had got down to here, I would exit that trade wherever it was. It's a indicator based exit. Yeah, I'm extended. I'm looking to scalp quick moves, and I can scalp multiple times on this by the time this is on its way down. Yeah, it's a multi time frame strategy. It's an old stock strategy. Used to trade it many years ago, but it works really well for scalping. You get in there with 10 lots, 10 contracts on an E-mini in the open in New York. You can be out with $2,000 in minutes. Obviously, you need to cap your downside, but it's scalping. It's fast, and you need a fast indicator, and all the RSI2 is a fast indicator. You're looking at the last two periods. What's the relative strength over the last two candles? Of course, it's going to do that because it's moving up and down. What's the relative strength over the last 21 candles? Well, it's fairly smooth. Swing. One's a swing trader, one's a scalper. Doesn't matter about the time frame. Let's do a session on futures. We can do, if you want to. I can do a session on futures. Not much different to what I've taught you already. Well, not taught you already, what I've talked about already. It's the same thing. getting in, getting out. You can flip a coin and do the same thing. This price that you see here on the Nasdaq is the same. So look at this. Let's look at the price action. Just screenshot that. So that's a 1 minute chart on the S&P 500 on CFDs. That is a chart of the S&P 500 on futures. It's the same thing. It's exactly the same thing. Just trade CFDs. The futures market, and look at the price action. It's the same. So you got that bull candle there, bear, bull, bear. Yeah, it's the same. It's the same price action. That big candle is that big candle. That run up there is that run up there. That down bit there is that down bit there. Price action is slightly different on futures, but what's happened here is, look, on futures market, because you're seeing every tick in the exchange, on the CFD, you're seeing a gap up, move down. So that is actually a bear candle, a shooting star. But your CFD broker quoted different prices because it was in his benefit to actually paint the candle different. Why? Because he could probably make more money by painting the candle different, because he will take more people's stops and things like that. We talked about that briefly yesterday, didn't we? Yeah, I mean, we can do a session on it, but it's the same thing. The difference between futures market and CFD market is you can't hold futures markets overnight because the cost to carry overnight is extortionate. You need a massive account. And a gap in futures is expensive. Yeah, so futures is typically more about looking for order flow imbalances and trying to just grab a bit, because you're limited to a contract. I'm trading the E-minis, but you could trade mini and micros, and one contract here, every time I press the sell button, here you can see it's costing me $1.25. So every tick, if it ticks, is $1.25 with one contract. That was a spread tick, so that didn't work. But 125, yeah. So I'm 125 up now. Still 125 up because I haven't actually got an order fill at that level. We're ticking. Yeah, we're talking about the market. You got a bid and ask. So you got the bid and the ask basically on the ladder. Yeah. So for a tick to occur, i.e. this to move down or up, that guy moved up. Now, for that order there to get filled, that's got to tick down. Yeah. If it ticks down 2 at a time, you get a gap. If you get a gap, you don't have a price change. Apart from that, that's the difference. You get to see the orders. Apart from that, it's the same thing. It's price action, pure price action. Oops. But we can do a session on it. But what you have with futures is you are limited to risk. So your risk is 125 a tick. If you take 2 contracts, it's $2.50 a tick. If you take 4 contracts, $5 a tick, so on and so forth. That's the only real difference with futures. And the other difference with futures is the FIFO rule, first in, first out. I cannot hedge. You see here, I have buy and sell buttons. I have sold. Yeah, it says -1 contract. If I now press the buy button, it will not buy. It will close my sell. remember what I was saying about how this market moves and why the market moves in the way it does. If the markets are selling, to exit, they have to press the buy button. So I was selling there. To exit, I didn't press close. I bought. I sold a contract and I bought a contract. As I bought a contract, if someone else had bought a contract with me, we would have created a tick up. That wouldn't happen with me because I'm trading tiny little things here. They're trading tens of thousands of them. But yeah, so that's how the market works. So the difference between futures and CFDs is if I come over to here and I press a buy button now and a sell button now, I will have a long order and a short order. You cannot hedge futures. You are either in long or you're in short. If I go short 5 contracts, market's really slow. 5 contracts is still a lot. If I go, this is risky. If I go short 3 contracts, yeah, and then I want to get out of this. If I buy 1 contract, see my number here, it says 3. Probably can't see it's dark, but -3. If I buy 1 contract now, just waiting for this to tick down 1. So I have to pay a commission every time as well. Pay a commission, round trip commission on every contract. This is the Globex session. Nobody trades this session. This isn't moving. Yeah, 2:30 this afternoon, this thing will be like a complete beast. It'll be all over the place. It's not even ticking. It's dead. They're all asleep. There we go. So we need another tick. So we've now got a spread. We've got a bid and an ask with a gap in the middle. No, they moved up again. So if they'd have moved down, that would now be saying 375 plus. Now I'm 750 down. So if I press that now, I just go down to 2 contracts. And now you see it goes to -5. And I've taken a $5 loss. Or a little bit less than that. So that's literally the only difference. So a good way of trading on futures is to build contracts. So basically what you call building a position. So all you're doing is I'm short now 2 contracts. Let's see what price does. I will need to put a protective order in up there of 2 buys because I've got 2 shorts. So if we get above that level, I want to be out. So I want you to buy me out of the contracts at that level. So it's the same principle, same thing. Doesn't matter what you do. If you're in the US, you have to do this. You can't trade CFDs. So if this now moves down, what I can do is add more contracts. So you build a position. And a lot of people position trade. They DCA. So going short here. If it pushes up into here, I'll short it again. If it pushes up into here, I'll take another one. If it pushes down, I'll add another contract. If it pushes up, I'll add another contract. So I'm building a position of somewhere between 5 to 10 contracts with an invalidation at that level. At that level, I place a 10 contract long, which basically closes in effect my position. But if it's an accumulation, it has a chance of doing what? Breaking long, breaking short. If it breaks short, I've got 10 contracts short. By the time I'm down here, I'm up $700,000. But I will always have an out at $400, $500 if you do it. There's many ways to do it. There is no right or wrong. It's totally binary because you can only buy and sell. There is first in, first out ruling, and you can't hedge. It's as simple as flipping a coin. You just have a condition indicator, typically, which people use to try and get a couple of ticks out. And the amount of money you made is based on the number of contracts you have. That's it. But it's the same thing. But every single thing that you see going here, these orders I have on now are showing to everybody in the world in the Chicago Mercantile Exchange. In fact, they're not. This is a demo account because it's a funded account. So, but it's if it was real, I would be showing my contracts I have short now. People can see them in the Chicago Mercantile Exchange, and I will sell to somebody else on the planet. That's the difference with CFDs. Every time you press the buy and sell button here, your broker goes, what should we do with this? Well, let's just take the other side of it because he usually loses. Or they'll say, all right, we'll take his commission and give it to that guy. So someone else at the time I press this button in the brokerage, another customer, you, will be pressing the opposite one. They'll just match us two up, take a commission out of both of us, and take the spread out of both of us, and do nothing. And if there isn't a guy pressing the sell button when I press the buy button, they will go, all right, we'll take the commission off of him and go and see what price we can get from the liquidity providers, the dark pools. That's how these brokers work. This is just a different mechanism for doing exactly the same thing. Take a loss on that. So there you go. Thanks to you, I'm now $32.50 down at the start of the session this afternoon. Literally, I'll have that back within seconds. This afternoon, this thing, well, you've seen what happens at the open with the stock index hedge, yeah? This is the pre-market, right? At the open, it's going to go like that, and it's just going to do that for hours. Yeah? One contract short on the minis here, yeah, if it moves down to there, is worth $100. And it will be there within seconds. A news event, you can blow an account within a second in a news event. This is why they don't on futures. This is why they do not let you trade news events. You have to be flat for news. If you're not flat on news and a news event hits ADR, the account will be blown. It won't just be blown. It's a 50k account. It will be sitting at something like 40. You'd be dead. You just don't touch it. You're flat on news. In fact, some of the futures, I was going for a button there. Some of the futures funded accounts have a mechanism in there where they will auto close and disable the buttons before the news, because you just can't do it. The spread on the ladder at the news goes like, I showed you the ladder there where you've got a person there and a person there and maybe a gap in the middle occasionally. When the news hits, there'll be orders up here, there'll be orders down there, and there will be a void. And if you've got one of these and you want to take the other side of the order, he's got to jump there, which creates a loss vacuum. And if that's you, you're dead. It's fun. It's such a fun thing to watch. But it's incredibly hard to make money out of it long term, because you are literally, unless you've got a really good strategy. With this strategy, I usually take somewhere in the region of 3, maybe 4 trades a day, which is why I kind of pricked up a little bit when you said about that. First thing I did was go, how many times do you trade this? Because if it's a good strategy, it will only give you 3 or 4 entries a day with a high strike rate. If you've got a 66% strike rate and you take 3 trades a day, you're winning. That's all you need. But if you're going with $1,000, you're going to make $1,000 a day. You might lose 2 to make 3. You make $1,000. That's what futures is. It's not about making large amounts of money. This account, I traded it for a day yesterday, but I only took I think the day before I only took 2 trades. But I'm up $700. It's not about making lots of trades. It's about making a couple of trades with big risk. Scalping. And this is what prop's all about. It's not about getting in with my target's three grand. I've done 700 in a day and a bit. Yeah, 5 days you'll be done. But you're only ever going to get 3 to 5k out of it unless you go in big. If you go in big, you can get a lot of money out of it, but you won't survive. You don't survive. But this is why everybody trades futures, because it's a way to make money really fast. But you can replicate this by changing the button up here to 5 on an index. Same thing. We could do a futures 101 for dummies, but it's not, yeah, I mean, I can do a session on it. I'm interested in how to apply ORB EA to futures market on MT5. It's exactly the same with proper lot sizes. So if you want to apply ORB or SIH on futures, you have to use fixed lot sizing, basically. So all you do, just shut that down. All you do is on the EA, you used fixed lot size. So you remove that and you put in there the fixed lot. So it'd have to be in increments of 1. So you would go 1 lot, 2, 3, 4, 5, whatever. Same thing. You can't use the SAH obviously because you can't hedge. So it, yeah. So I mean, what? That's the propulsion. No, it's not. Yeah, it is. That's the propulsion gap just done on the DAX. So yeah, on SIH, what you would do, because what this does is it places a pending long and a pending short. Those orders are absolutely fine to enter into the market. So I can do that, no problem. So I can put a pending sell stop and a buy stop, no problem. So this is the equivalent of SIH. So I'm going to go long there and short there. If the market goes down and we get a clean break, fine. If the market goes down and goes up, I don't hedge. I close the position. So if you wanted to use SIH, it's not going to work because it's just going to shut you out in the futures market. What you would need is up here 2 buy stops and 1 short. So if it broke short and then you wanted to go long on that break, you need 2 orders there because one of them is going to close out, the other one is going to go long, and then you'd need to place a single long, single short down there. ORB, you should be able to do the same thing in the ORB, shouldn't you? Yeah, so in ORB, you use fixed loss and a percentage of the opening range for a stop. So you just use fixed lots and you would use 1 contract. So what it would do is it would place a pending order long and a pending order short. And that's it. Same thing, isn't it? As far as I know. I mean, I've never tested it on futures in MT5. I don't use MT5. I don't have a broker that has futures markets. So I don't know. But whatever you're being given as an instrument, it will ask you when you enter for a lot size. Trailing stops don't work properly. Well, the trailing stops are nothing to do with the market. The trailing stops are to do with price. So your trailing stop is a percentage of the opening range or a distance to trail, or you can use, yeah, that's it. So it's a percentage of the opening range. It will automatically trail. But yeah, no, there's nothing wrong with it. It works. It's EAs don't work on markets. They work in MT5. So when the price moves up, if the movement is that, and the EA is told to move up by that, that will move up by that. But if there's some weird thing in futures markets that mean it doesn't work that way, I don't know. Put it this way, I've had the EA out there for 3 years. No one's mentioned a problem with anything. So you're the first person that's mentioned that they haven't got a problem with it. So I don't know. But it's hard for me to test stuff. I'm not in the US. I don't have access to the same people that you have access to. So I don't know. Anyway, this session's gone on long again. Time's up. Look, we are bloody hell. It's 11 o'clock. So yeah, I will work on that a little bit more, and we'll look at that next week. If anybody's got anything they want to cover next week, let me know. At the moment, I haven't planned next week at all. So I'm going to do probably some more theory next week, mixed in with some testing of what we're doing at the moment, which is basically testing Phil's strategy out a little bit more. So I'm going to build that out and build some more functionality into that, and then we'll go from there. But if there's anything you want to cover next week specifically, then let me know. RSI2, indeed. We could look at building out an RSI2 strategy. We could try that. We could try that strategy. Well, Swiss Army knife can do that already because it's got RSI2 built into it. Yeah, we can use that. We can do that because it's got an RSI trigger, hasn't it? Yeah, RSI. So yeah, I could use the Swiss Army knife. We can test all sorts of stuff with that. Oh, we'll put that on my list. Wherever my list is. I'll put that on the list. We will do that. We'll do a strategy development one on RSI2 next week. Good idea. Like it. RSI2 on M15 using M5. Galps. There we go. We'll see if we can build a strategy out. Well, we'll back test it basically and see if there's an edge. Sounds like a plan. Right, I'll be back on Monday and we'll do some of that. But yeah, I'll publish over the weekend what the member streams are going to be next week. But if there's anything you specifically want to do or see, let me know in Discord. But I have got other development sessions done, kind of what I covered in the live room this morning, unfortunately, which was the probabilities of trading. But I had a session planned on that. I might still do that actually, but do it properly so that it's there. Yeah, I've got other news trading strategy development ideas. So there's a lot of strategy development stuff that specifically I've got planned. And partly one of the reasons I want to do these is so that I actually get it done, because I go off on tangents all the time and I stop doing things. But if I have a session planned to do something for an hour, I will do it. So all these little bits and pieces, it helps me do them. And obviously it also helps you either go down that path or not go down that path, obviously. So, but yeah, approach trading as a business and focusing on the specific tasks, all sorts of things I've got planned. So I have got content ready, but anything you want, we'll do that first. So for Youssef, we will look at RSI2 next week and see if we can develop this further. Might also, just looking at it here, might also be something that works well with divergence, because divergence is very good. I'm just scanning it. Actually, it's got quite a few divergence signals. By divergence on this particular thing, I mean a double top at 95 and a higher high. Yeah. Bearish divergence. Those two signals are stronger because they have divergence, confluence. Might be worth getting an RSI indicator with divergence built in to test that. We'll have a look at that. Looks good. I like it. I like scalping strategies, and I'll look at a future session then. So maybe we'll do a future session for the US people, although I haven't got many US people because I'm doing the streams in the morning anyway. Right, I'll be back on Monday. Anything you need, let me know in Discord. Other than that, I will work on this further and field strategy, and then we will pick this up again next week. All right, have a good day. Anything you need, let me know. Watch out for the news on the CAD this afternoon, and I will see you guys next session.